Hello, my dear learning community. Today we are going to look at the two bases of accounting used to prepare the financial statements. The two bases of accounting are cash basis and the accrual basis. We will look at both methods in detail and how each one would affect your business. Okay, let's get started. Accrual method. Under accrual method, revenues are recognized when they are earned and expenses are recognized when they are incurred. Meaning, revenue is reported on the income statement when it is earned and expenses are recorded when it is incurred. The accrual method is considered to better match revenue and expenses and standardizes reporting information for comparability purposes. It is because of accrual accounting that we have the revenue recognition principle and the expense recognition principle. It is also known as the matching principle. Under cash method, revenues are recognized when cash is received and expenses are recognized when cash is paid. Meaning, revenue is reported on the income statement only when cash is received and expenses are recorded only when cash is paid out. So it clearly says that transactions are not recorded in the financial statement until there is an exchange of cash. Let's look at this in a bit more detail. Difference between cash accounting and accrual accounting. The core underlying difference between the two methods is in the timing of transaction recordation. When aggregated over time, the results of the two methods are approximately the same. Accrual basis of accounting provides a better sense of the financial well-being of a company. It gives a realistic financial view of a company. The accrual basis system recognizes revenues and expenses in the period in which they were earned or incurred. This will lead for an even distribution of income and a more accurate business of daily operations. So accrual-based accounting information helps management to analyze a company's progress, and management can use that information to improve their business. And having comparable information is important to external users as well for their investment or lending decision making. Cash basis of accounting mislead investors about the daily operations of a business. It can mislead investors about the daily operations of a business. It is not accurate. The cash basis system delays revenues and expense recognition until cash is collected, which can mislead investors about the daily operations of a business. Accrual-based accounting incorporates matching principle, whereas cash-based accounting violates matching principle. Balance sheet and income statement reflect the accrual basis of accounting. Statement of cash flows considers the incoming and outgoing cash transactions. Accrual basis of accounting is commonly used by many businesses. Most financial accounting processes focus on the accrual basis of accounting. Cash basis accounting is a simpler accounting system to use than an accrual basis accounting system when tracking real-time revenues and expenses. Many small businesses opt to use the cash basis of accounting because it is simple to maintain. An example of the two methods would probably help clarify their differences. I will show you an example, a very simple example. Assume that a business sold merchandise to its customers on May 29 and the customer picks up merchandise and pays the business $100 on June 2nd. If the business were using the cash method, the revenue would be recognized on June 2nd, the date of payment, and any related expenses would be recognized when paid. If the accrual method were used, the business would recognize the revenue and any related expenses on May 29, the day the sale was occurred. Businesses often sell items for cash as well as on account, where payment terms are extended for a period of time, for example 30 to 45 days. Likewise, businesses often purchase items from suppliers for cash or more likely on account. Under the cash basis of accounting, these transactions would not be recorded until the cash is exchanged. In contrast, under accrual accounting, the transactions are recorded when the transaction occurs, regardless of when the cash is received or paid. Imagine you perform the following transactions in a month of business. We will see how these transactions would be recorded on the income statement under cash basis and accrual basis of accounting. Transaction number 1, sale for cash. This would be recorded in financial statements at time of sale under both methods. It makes sense because the business sold the merchandise to the customer and received the money from the customer at the same time. It is considered two events that occur simultaneously. Transaction number 2, sale on credit. This would be recorded under accrual method at time of sale, but it will not be recorded under cash basis until cash is received. Let's now explore the difference between the cash basis and the accrual basis of accounting using an expense. A purchase paid with cash at the time of sale would be recorded in the financial statements under the cash basis accounting. It makes sense because the business received the supplies from the supplier and paid the supplier at the same time. It is considered two events that occur simultaneously. Exchange of merchandise for cash. Purchase on account would not be recorded in the financial statements until the cash is paid under cash basis accounting. Under the accrual basis of accounting, this purchase would be recorded in the financial statements. The fact the business will pay later is viewed as a separate issue under accrual accounting. Let's look at an example of how cash and accrual accounting affect the bottom line differently. And this example will illustrate why accrual basis accounting might be preferred to cash basis accounting. In January, a business had the following transactions. We are required to calculate the store's net income for January under the accrual and cash basis of accounting. On the left hand side, a list of transactions are given. The comparison of cash basis and accrual basis income statements is presented on the right hand side. Abhishan store commenced operations on January 1st, 2020 when Ranjan invested $30,000 for all of the common stock of the firm. How we are going to record this transaction? This will not be recorded in income statement. This will go to the statement of financial position, so we don't need to worry about this transaction. We'll go to the next one. The firm rented a building on January 1st and paid 2 months rent in advance in the amount of $2,000. Under the cash basis system, an expense is going to record the day the payment leaves business hands. In January, business paid 2 months rent $2,000. But since the cash went out, the business will record $2,000, the full amount, as an expense. Under accrual accounting, expenses are recorded when they are earned and not when paid. Business paid 2 months rent $2,000. Therefore, rent per month is equal to $1,000. The business will record only $1,000 as rent expense for January. On January 1st, it is also paid the $1,200 premium for property and liability insurance coverage for the year ending December 31st, 2020. Under cash basis accounting, the business will record the entire amount $1,200 as an expense in January. Under accrual accounting, insurance expense is spread out over 12 months. And each month, 1/12 of the total insurance cost is expensed. 1/12 of $1,200 is equal to 100. Therefore, business will record 100 as insurance expense for January. The firm purchased $28,000 of merchandise inventory on account on January 2nd and paid $10,000 of this amount on January 25th. On January 31st, the cost of unsold inventory merchandise was $15,000. Under cash basis, the business will record $10,000 as cost of inventory sold since the cash went out. Under accrual accounting, business will record $13,000 as cost of inventory for January. Let me tell you why. Business purchased $28,000 on January 2nd. The cost of unsold inventory was $15,000. Therefore, the difference between the two, $13,000, will be the cost of merchandise for inventory. During January, the firm made cash sales to customers 20,000 and sales on account 9,000. The firm collected 2,000 from these credit sales by the end of January. Remember, in a cash basis system, you will record the revenue when the money is received, no matter when the service is performed. 22,000 received from customers in January, 20,000 from cash sales and 2,000 collected from credit sales. So the company under cash basis system would record 22,000 revenue in January. In accrual accounting, we record the revenue as it is earned. Business will record cash sale 20,000 and sales on account 9,000 as revenue for January. Therefore, 29,000 will be shown as revenue under accrual basis in the income statement. Remember, it does not matter whether or not the cash came in. The firm paid other costs during January as follows: utilities 400, salaries 650 and taxes 350. Business paid expenses immediately after incurring them. All three expenses were paid in the same month. Both events happened on the same month. So how we are going to record in income statement? Under both methods of accounting, business will record utilities 400, salary 650 and taxes 350. We'll look at the difference in the presentation. Under the accrual basis of accounting, January's month profit would be $7,400, whereas under the accrual basis method, January's month's profit would be $13,500. This shows how much difference can be seen in a company's profit and cash flow for a given period just by deciding what accounting system to use. Compare the two income statements. Look at the cash basis figures. How realistic is this picture? It's not accurate. Look at the accrual basis figures. Here you see a better picture of what really happened in the month of January. Relevant revenues and expenses for the month of January reported in the income statement. This comparison can show the dangers of reporting in a cash basis system. In a cash basis system, the timing of cash flows can make the business look very profitable one month and not profitable the next. But accrual based income statement accurately portrays what is happening in your company. It gives more transparency and detail in reporting. So accrual accounting gives a better indication of business performance. In summary, under cash basis accounting, transactions are not recorded in the financial statement until there is an exchange of cash. This type of accounting is permitted for small businesses that elect to use this type of accounting. Under accrual basis accounting, transactions are generally recorded in the financial statement when the transactions occur and not when paid, although in some situations the two events could happen on the same day. I hope this video was useful for you to understand these two accounting methods. Thank you.